The first half of 2013 was unfavorable for gold prices. Here to talk to us about what he is expecting in the second half of this year is Frank Holmes. This is the CEO of U.S. Global Investors. Frank, so happy to have you.
It's great to be back.
So Frank, what are you looking at with the yellow metal in the second half of this year? Are we going to see more declines?
Well, I think the odds favor. There's a real true seasonal pattern to gold that bottoms every summer and runs to the Chinese New Year due to a set of religious holidays and festive holidays throughout the other part of the world.
So are you right now then going to be a buyer of gold?
Well, we're always along because we have gold funds, and one of the big parts of that is always advocating that investors consider having a 5 to 10% weighting, but no more, and rebalancing each year. It's just shown over decades to be very prudent to have this weighting.
Yeah, I mean, 5 to 10%, probably higher than most investors. Why are you guys so high on it?
Because we've done this mathematical modeling to take a look at what would improve your returns and lower your volatility over running 10-year periods.
Now, a lot of people looking at physical demand, right? In India, there's the tax on imports, which is affecting gold prices. Do you see this as being a problem going into the second half of the year?
Well, I do think it's had a big impact, and at U.S. Global, we always say that government policies are precursor to change, and we like to look at the fiscal and monetary policies of the seven most populated countries where you appear to get the strongest gold demand for what I call the love trade, that demand part. And the tax in India has had an impact, especially the 6% tax was imposed in January. It's interesting that, but once gold fell, that 6%, immediately cash buying started out of the rest of the part of the world, and even North America. And we're still seeing that strong cash buying taking place.
Now, what kind of price are you looking at, price level for gold?
Well, gold right now is below its marginal cost of production. So gold mining companies are struggling here to drop their costs. That means they're going to have to slow down their production profile growth, stop exploration, etc. And what that's going to do is slow down the supply of gold from mines. So I think over the next couple of years, that's bullish from a supply point of view. From a demand point of view, what's very important in looking at gold is the GDP per capita for what we like to call Chindia, China and India. It's been stagnant for the past year, and that does have an impact on what I like to call the love trade.
So finally, the gold miners obviously have had a really difficult time in this environment. Do you see those troubles continuing?
Well, I see right now when I talk to the CEOs, a full court press on cutting costs, cutting exploration, and improving that return on capital. Barrick has hired a new CEO, and that CEO is Goldman Sachs model of returns on capital. So that's going through reorganization. They've sold their oil assets. Newmont sold their oil assets. Barrick hasn't done that yet. You're seeing restructuring taking place. So I think you're going to see probably a trough take place over the next 6 months for gold stocks. They will move up in sympathy with what's taking place with the rise in the price of gold, but the leaders will have higher profit margin, higher grades of gold, and pay dividends.
All right, Frank. Well, thanks so much for your take. You heard it from Frank. He is looking at these gold miners. They could continue to struggle, but keep an eye on them. For TheStreet, I'm Joe Deaux.